Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, Mention and other fine folks, to the Someday Dispatch of the Black Letter, where we contemplate thoughts worth thinking as we try to navigate this upside down and create better lives for ourselves during these difficult and unprecedented times. We've got a few things to look over today. We're going to, of course, look at precious metals, the economy, also how things are working politically, if that's helpful, what we might expect at the end. Of course, these are ongoing themes that we try and think about as we try and navigate where things are at, where we are at in the current economic depression, which I think it is. And we'll look at sort of the larger picture, as well as perhaps on some of the minutiae as well. And then, of course, we'll check the markets, those that are at least open, which would be, I think, well, precious metals might not be, but we'll take a look anyway. And cryptocurrencies, of course. So first up, the silver pressure cooker from the Silver Seeker. The silver market appears ready to blow its top, much like a pressure cooker whose relief valve stopped functioning even as the heat and pressure continue to build. The market is also likely to overheat, but at least in gold, its relief valve, the price of gold, appears to be functioning somewhat and has bled off much of the pressure. It's quite different in silver, since prices have barely changed on a year-to-date basis, and current prices are still close to 65% below the highs registered both 40 years ago and again 9 years ago. Nothing could demonstrate the malfunctioning of silver's price relief valve relative to gold than the recent 5,000-year undervaluation of silver to gold. And of course, we've been talking about that. The silver to gold ratio is at historic highs generally. It's very few times in its history that it's been this high relative to gold. I mean the ratio itself, which means that generally the higher the ratio, the more undervalued silver is as compared to gold. As for why, the release mechanism was gummed up due to concentrated short selling on the COMEX. For years, the concentrated short selling was led by JP Morgan, but the bank has recently abandoned the short side, leaving 8 other big shorts to deal with the mess when the lid blows off. Massively insane quantities of physical silver purchased by and deposited into the world's silver ETFs, led by the largest, SLV. More physical silver, 220 plus million ounces, has been deposited into these investment vehicles over the past few months than at any time in history. So it's just a matter of time until silver price starts to reflect what it's really been up to lately. More of a commodity being bought in the shortest time ever should result in a sharp price advance, most like the sharpest in history. So we're not seeing that with silver especially. The price of silver is not functioning. Stated differently, this is yet another clear proof that the price of silver is being manipulated. The pressure for higher prices, more than ever seen in any other commodity, has to blow up at some point, and all the signs suggest explosion may be at hand. Even in the 2 previous silver price runs to $50, the short sellers never fully capitulated and managed to then rig prices sharply lower in a fraction of the time it took for prices to rise. Since so much silver has been acquired before prices have climbed much on this go-around, the prospects for massive downside liquidation appears rather limited, because there's so much in the ETFs, for example. This is what separates silver from gold, namely it is conceivable for the concentrated short position in gold to be offset by physical metal, while that would seem to be impossible in silver, because there doesn't seem to be as much silver available currently, I think, in order to short the market at the same extent, especially with JP Morgan having sold so much to the silver ETF, right? Interesting article, quite long. Obviously a guy who knows more about precious metals than I do, but interesting to think about. As we know, silver is a very small market. I think the total market of silver is less than 100 billion. It might be around 40-50 billion if I remember the numbers correctly. We looked at that some weeks ago. So when you have such a small market, of course, it's easier for folks who have large amounts of fiat currency to manipulate, and that's what's obviously been happening. And as most of you who are well versed in precious metals will know. From the economic prism, we see this article about game over spending. The Dow booked its best quarter in 33 years. The S&P 500 posted its best performance since 1998, and the Nasdaq had its biggest increase since 1999, jumping 38.85% in just 3 months. So it looks like the stock markets are partying like it's 1999. The economy, on the other hand, was severely scorched, as we know. He talks about all the things that have happened. The interim solutions from Washington in concert with the Federal Reserve have been to add more fuel. That is, the solutions have centered around mega efforts to paper over the economic depression with massive amounts of fake money. The money printer go brrr. Payroll protection program loans were made to over 650,000 small businesses, including Kanye West clothing brand Yeezy, etc., etc. It's just outrageous how this has been mismanaged. And frankly, people are just greedy. those that are wealthy just seem to be even more greedy, and they want to have more and more money. It's just astonishing to me. There seems to be no end to the depths of greed for some folks. As of June 28th, the Fed bought $428 million worth of corporate bonds in 86 different companies, including McDonald's and Berkshire Hathaway and Apple as well, as I understand it. These are companies that clearly do not need Fed help. The $600 weekly additional CARES Act payments are scheduled to end on July 31st, and it doesn't seem like those will be coming back, or that additional payment will be renewed. Many of the jobs lost because of government lockdowns aren't coming back as well. The Treasury is queuing the checks up so they can be sent out very quickly, says Munition. The U.S. budget deficit in June was $863 billion. For example, the budget deficit from June 2019 was $8 billion, so it's a 100-fold increase. Instead of just an economic depression and a financial crisis, we'll also get a dollar crisis. And I think that's inevitable. As a non-American, I'm certainly getting tired of the American ability to maintain its reserve currency status, especially the way the current regime has been treating allies, not to mention foes. The US has had a special privileged position in having the reserve currency, but it's clearly been shown to be used as a weapon against many of its foes, as also against its allies. There's recent talk of tariffs against France, for example, because they wanted to put in taxes on large tech companies, which doesn't seem outrageous, and yet the American government seems to think that this is something they need to step in to help their precious babies. And the world is getting tired of American hegemony, I'll be frank with you. And it's not just with its foes, it's its allies too, which is perhaps the biggest problem. However, the unwinding of the US dollar is going to take some years. But I think with cryptocurrencies, XRP, as an example of blockchain technology, we could probably see that we have some sort of a basket of digital currencies that are used as a peg, probably by the end of this decade, if not sooner, maybe by 2025. Who knows, but we'll see. I think the reserve currency status of the US dollars is on the ropes. And here we go. The extra $600 employment payment benefit probably won't be extended. Here's what to know. At the end of July, as the end of July draws closer, tens of millions of Americans are set to lose the $600 a week in federal unemployment benefits. In the next stimulus package, the Trump administration wants to cap the benefits so that workers don't receive more in unemployment than they did at their jobs. And that's understandable. But then the other side of the coin is that perhaps these jobs are not paying sufficiently enough, not a livable wage, and I'd argue that they're not. An estimated 2/3 of displaced workers are eligible for benefits in excess of their normal wages. So that's going to be a lot of people. 2/3 of displaced workers, that's probably in the tens of millions of people who are relying on that extra $600. Critics of the enhanced unemployment benefits say it disincentivizes people from going back to work, but others say it's necessary when around 33 million Americans were still receiving jobless benefits at the end of June. Recent research from Chicago Federal Reserve found that people receiving unemployment benefits are actually more likely to look for jobs than those who have exhausted their benefits. And I think that's true. However, I'm not sure if that includes this extra $600. I mean, if you are making more at home than you are at work, I would certainly not be incentivized to find work. I would be taking my time. But I think what's talking about here is that once your benefits have been exhausted, then I think you start to lose hope, and you can get into an easy and quick spiral of depression and anxiety, which probably doesn't help. And then these folks start to leave the workforce. And if they don't have many means, it can cause additional problems for the economy. Income for women and people of color will be hit especially hard if the $600 benefit expires. And of course, we have great problems in the United States and in much of the world, actually, with racial tensions and misogyny as well, right? The Me Too movement only happened, what was that, just a couple of years ago, a year ago? So we need to be making sure that we protect those who are most vulnerable. The House passed a bill in May that would extend the enhanced $600 benefit through December 2020 and provide another stimulus check to households, but that bill is not expected to pass. Meanwhile, the Senate has not unveiled anything of their own. So you have the Democrats, you know where they are. They're trying to help the man on the street. You have the Republicans, you know where they are. They're trying to help the Wall Street buddies. It's just as easy as that. I think this whole swamp that Trump was going to drain certainly hasn't turned out that way. In fact, he's just made it deeper and muddier with all sorts of his cronies and everything else. It'll be interesting now that the Supreme Court has decided that his taxes have to be released, what we'll uncover in those monstrosity of documents. Macro view, the threats to the bullish thesis have grown from real investment advice. In recent weeks, the threats to the bullish thesis have grown. The Fed was able to inflate another asset bubble to restore consumer confidence and stabilize the credit markets. The problem is that since the Fed never unwound their previous policies, this time there are 50 plus million unemployed. Wage growth is declining and bankruptcies are on the rise. The Fed's attempt to inflate another bubble to offset the damage from the deflation of the last bubble will likely not work. Plus, it's getting harder and harder to get the same juice out of the machine, right? What is most imperative for the Fed is those market participants and consumers believe in their actions, and this is what you rely on in a fiat system, right? You have to believe, everyone needs to believe the same story, that everything's the same, and we can continue this approach, when in fact we're seeing that the wheels of the train are starting to come off. We have people who are rioting in the streets, who are upset, arguably for a lot of reasons, and primarily there's this inequality and this wealth gap that's been created by the Fed's manipulation of the markets and the stock market primarily, because all that money goes to folks who have assets, and most folks can't even come up with $400 or $500 at the end of the month for an emergency. So you can see, arguably, that maybe the top 40% of people are the only ones who have real assets, such as real estate or stocks or bonds, etc., all three of which are in nosebleed levels and in bubbles, in my opinion. After the financial crisis, the Fed hoped they would be able to reduce their accommodation as economic growth and inflation returned, but you can see that is not what happened. As soon as they started to try and taper, the market had a bit of a tantrum, and then they had to start going up again before this whole big debacle. As each year passed, more monetary policy was required just to sustain the economic growth, and you can see that. At the end of the QE1, there was 2.3 million, QE2, 2.8 billion, Was that trillion? I'm not sure. But those are large numbers anyway. The key is it's been going up all this time, right? You can see the increases get larger and larger. And the gains have been sort of somewhat steady for the amount of effort required, right? There is a diminishing rate of return on QE over time. Since QE requires more debt to be issued, the consequence is slower economic growth over time. And here we can see that debt is growing faster than GDP. Without debt, there has been no organic economic growth. So this is the orange line, is the cumulative debt growth. You can see here at about, I guess, the last financial crisis is where they crossed over. And that's the cumulative real GDP growth. Dipped during the financial crisis, and it's dipped here again. And that's probably going to get worse too. One way to view this problem is by looking at the NASDAQ 100 versus the S&P 500 index. That ratio is now at the highest level ever. You can see here the NASDAQ to the S&P 500. Bubblicious. Over 25 years, the NASDAQ 100 S&P 500 ratio has hit 4 standard deviations of the 4-year moving average only twice. And once was back here during the dot-com boom, and now. And this is even higher. So that doesn't bode well necessarily if we look back at history and how that resolved. And then here's the bear case from his colleague Doug Cass. So at the core of his concerns are important industries getting gutted, a negative knock-on effect that affects other industries and smaller businesses, tangential industries as they call it, widening income and wealth inequality, which we've talked about as well. It's only getting worse with the more printing that the Fed does, a battered public sector because you're going to have lower taxes, and then rising taxes and redistribution just to help pay off some of this. There are substantial impacts to companies individually, such as weak capital spending, higher costs and lower profit margins. The competitive influence of zombie companies exacerbate lower profitability. These companies compete aggressively on cost and take longer to die due to low interest rates and weak loan covenants, which means it's gutting up the system, right? Gumming up the system. Small businesses gutted. The specter of the secular erosion in unemployment, permanent job losses, more cautious business confidence and spending because of the financial situation, the economic situation. Financial repression holds multiple risks. A sustained period of low interest rates to offset reduced economic growth could backfire. The political stasis, political divisiveness is becoming even more and intensifying in that way. But the overly bullish sentiment is, but what about the Fed? Below is the percentage of Russell 2000 firms that have negative operating earnings over the trailing 12 months. It just moved above 30%, the most in over a decade. Only twice before in 20 years have such a high proportion of these small companies lost money. Nearly a third of small cap stocks are losing money. You can see we're getting close to the bubble territory of the financial crisis as well as the dot-com bubble, right? So it shows you where we really are, folks, regardless of where they want you to believe they are. And furthermore, you have a near record number of small traders speculating on asset prices through the use of options. Small trader call buying, you can see it's at all-time highs in almost 20 years or over 20 years. And then current PE based on 2-year forward estimates. By nearly any metric, stocks are extremely overvalued. And now, as noted previously, investors are also using 24-month forward estimates to justify overpaying for assets, which I've never heard of. It's outrageous. Even at that, the Russell 2000 is at nosebleed territories. And even these are all a little higher than normal. But that's based on 2 years. You can't, in other words, you're going to take you 2 years to get to this point if that nothing changes, which means that, you're buying from the future trying to bring it back, and the piper must eventually be paid. Statistically expensive by almost every measure. The S&P valuations by metric borders indicate expensive relative to history. Pretty much all the metrics. The trailing PE, trailing gap PE, forward and consensus PE, trailing normalized PE, median forward PE, Schiller PE, price to book value. I mean, all these different things. Trailing peg, price to earnings growth, forward price to earnings growth. I mean, it's just insanity. I don't know how anyone can think that things are great. At the moment, none of these risks seem to matter clearly because the market has been going up. These are not an ingredient for a bull market or rising valuations. Instead, the above factors may be an ingredient to increased market volatility, increasing economic uncertainty and cautiousness in the C-suite, an irregular period of growth, lower price-earnings ratios, and more social unrest. And that's if we don't have a market crash, right? So, folks, things are really in a bad state. And I think it's important that we really understand that, see the wood for the trees, right? The forest for the trees. Okay, let's take a look at the gold market, see if that's changed. Of course, as we saw yesterday, things were mostly in the red. Or were they? No, I think just NASDAQ was in the red, and Dow and S&P were slightly in the green. Now, they ended the session yesterday all in the green. Okay, let's look at gold. Okay, so it doesn't look like gold is being traded on the weekends. You can see it's still up year to date quite well. And the same with silver, it's also not being traded on the weekends, because here we were at it says the 13th of July, but I think that's just crossing over to Monday, right? Still slightly up. I think what we saw last time, 4.93%. And now onto cryptos. So cryptocurrencies are generally holding steady over the last 24 hours. Generally up though, however, over the last 7 days. XRP up quite well, 13.9%. Cardano even more, 26% over 7 days. Chainlink, wow, 28%. Stellar, 42%. Wow, that's crazy. Glad I have a little bit of Stellar. And VeChain, 80%. Magnificent. So there you go. Market cap in the coins. Now let's take a look at the online oracle, the 8-Ball Economist. With all the madness in the market and the economy specifically, I wanted to ask the online oracle if there will be a correction in the stock market before the election. And I'm not sure if there will be, or if the shoe will drop after the election. As you know, I seem to think it'll happen after the election, but let's see. It is certain. Okay. Well, if the online oracle, the 8-Ball Economist, is right, then hopefully I will manage okay with the money I have, the market shortened. We'll have to wait and see. There you have it, folks. So thanks so much for joining me. I appreciate you. Thanks for your comments below. And stay safe out there and stay kind and healthy. Remember, I hope that some of this has been helpful as we try and navigate this uncertainty and build better lives for ourselves. So take care of yourselves. And remember, above all else, Dum Spiro Sparrow.